Now, let's talk about the different stages of the money laundering process. Essentially, money laundering, if we reduce the issue to its core, consists of 3 stages. In each money laundering activity, we can distinguish placement, layering, and integration. What is placement? Placement is when the money first enters the financial system. This is the riskiest step, because we have an amount of cash, but we have no legitimate justification for where this money comes from. The goal of this placement stage is to make the money more liquid, easier to use, meaning to transform or to put the cash into a bank account, and from there to be able to use the money within the formal financial system. Before the money can enter the formal financial system, preparation is often needed. This means, for instance, that to put money into a bank account without raising suspicion, a large amount of cash is deliberately divided into smaller deposits or transfers to be deposited into multiple bank accounts. This classic money laundering technique is called structuring or smurfing. It is used to avoid reporting requirements for deposits above a certain amount or other scrutiny. So in brief, you take the cash, break it into smaller amounts, and try to deposit it in one or different banks. The second stage of money laundering is called layering. This is the stage where illicit money is blended with legitimate money, or placed in constant motion. So, layering often involves generating a number of different transactions in a way that the origin of the laundered cash becomes hard to trace. For instance, illicit money can be used to gamble, then placed into stocks, then shuffled around in different currencies in different countries, or be transferred into bank accounts in different countries, then used to buy financial products like life insurance policies. There are many ways of layering. How it is done mainly depends on the creativity, the experience, and the opportunities that criminals have. There are different schemes, but in all schemes, the purpose of the layering stage is to make it difficult for even well-trained accountants to differentiate between money that came from legal transactions and money that came from funds that were placed for laundering. The third stage of money laundering is the integration stage. Integration is where money re-enters the legitimate economy. The laundered money appears to come from a legal business or legal investment, and the trail becomes extremely difficult and complex to follow, so the money can then be placed into larger-scale investments. This money is called integrated cash. Integrated cash is often placed in luxury assets, properties, long-term investments, or new businesses, and integrated cash can also be used to purchase assets that can be used to facilitate future money laundering more safely. Our next video will explain some practical examples.